Welcome to Contractor Cuts, where we cover the good, the bad, and the ugly of growing a successful contracting company.
Welcome back to Contractor Cuts. My name is Clark Turner.
I'm Jared Flo.
Thank you for joining us again. So this week we are talking about finances. The number one question I think guys have for us coming into this is, how do I understand my numbers? What should I be looking at?
Yeah.
My numbers are all over the place month to month. I don't know how to track it, how to look at it. And really the way that most contractors run is I'm doing my work and I'll look at the numbers at the end and see if I got money left over.
Yeah.
Right.
Yeah.
Or I look at my bank account and I got $130K in it. So I must be doing good. Right. And so today we're going to break down how you should look at your numbers.
Well,
right?
and when there's no money in the bank account, they don't know why. That's the problem. Is it's running it where I spend everything on my credit card and then I invoice my client, deposit the money, and if I have more money than I deposited and can pay off my credit card, I did good.
Yeah.
That's good and fine as a small one-man show type of thing. You have to know how to understand your numbers to be able to make business decisions based on your finances, and that way of doing it is it's too cloudy.
Yeah.
You can't do it that way.
Well, and in construction, it's one of the only companies or only really areas of work that you oftentimes get paid up front for money for work that is not going to be received for 2-3 months, right?
Yeah.
So an invoice in our industry isn't money earned. Mm-hmm. An invoice in our industry is how much money I want you to give me so I can either spend it on your job or I've already spent it.
Yeah, like a warehouse sends out 5 crates of trinkets to their client and then sends an invoice to them.
Yep.
They have rendered the services and send them an invoice for, hey, this is coming to you. You owe us this money, whatever.
Yep, it's a straight exchange. So when they create the invoice, when you go to Amazon and buy a set of headphones, right? I go on there and I give them the money, right? I make the purchase and then they send me the headphones. And so their cost is building those headphones. Their invoice is for what they're delivering on what they've already spent. Mm-hmm. And in construction, many, many, many times you're invoicing work that hasn't started. So you can send an invoice for $50,000. Well, I've spent nothing. And so on my P&L, my profit and loss report, it's showing a $50,000 gain and zero expenses. Yeah. So it looks like a positive.
We've talked about this before also that, in that scenario, there's a high possibility that I look in my bank account and I've got a ton of cash.
Yeah.
Which means, oh man, I'm doing really, really well. Nah, not really, because a large amount of that front end deposit has to be paid to execute the work that $50,000 was for.
Yep. You're going to spend $80,000 on that job total.
Yeah. And
you got 50, yes, but you don't have 50 to spend and pull out and put in your pocket.
That's right.
So today we're going to talk about what numbers should you be looking at and how to accurately find those numbers. Mm-hmm. And then next week we're going to talk about, okay, now I know my numbers, I know what I'm looking for. What should I be doing week in and week out to manage and understand my numbers as they change, to help me start looking and projecting in the next month and the month after, to where I'm not reactive, as we'd always talk about, but I'm proactive with how I'm dealing with cash.
Well, and in this industry, because it is a cash in, cash out industry, that piece of it, learning how to do that well will decrease your stress tremendously.
That's
so
right.
It's really, really important.
So there's 3 main things if you're new at looking at finances, or if you've been doing it for a while. We want to start with 3 main numbers that you're going to find.
Yeah.
First number is your revenue, right? On a P&L, if you're looking at QuickBooks, it's whatever invoices you've sent is what they count as your revenue.
Yeah.
For us, we view revenue in 2 different columns. You've got your earned revenue and the unearned future revenue, right? And so for us, if we have a $100,000 job and I get a 50% deposit up front, so I get $50,000 deposited in my bank account, all of that is unearned. Now, if I go and buy $10,000 worth of materials and there's 30% markup on the job across the board, I can say, okay, well, I've earned $13,000, right? I've earned the 10 that I've spent and the 30% markup. So there's $13,000 in out of this 50 that is earned, quote unquote. 10 I spent, the other 3 is could be put in my pocket, but there's still $37,000 sitting there that is unearned. But if you look at my numbers, it's an invoice, and QuickBooks tells me that I got that cash in my bank and I'm good to go.
And that's how a P&L can really throw you off.
Yeah, especially in construction. So that's what we're looking for is your earned revenue. If you're looking at your whole revenue as a whole, that we can use that number, but it's going to be less accurate.
Yeah, you just need to know what you're looking at when you're looking at your whole number as revenue.
Yep.
Some of that is going to be earned and some of that is going to be unearned, and you need to know what's what.
Yep. So that's the revenue that we're going to be looking at. That's the first number. And spoiler alert, in a few months we're releasing the program inside of our software to be able to get this number with the click of a button. So you can see your earned versus unearned per job across the board for the month, however you want to look at it. No other software has that out there right now. Yeah. So that's coming in our report section. But going back to what we're doing, the three different things, we've got the revenue that we're looking at.
Yeah.
Next, we call cost of goods. And for us, and this is where people get lost sometimes, we don't try. You've got to draw a line as to what you're counting as cost of goods and what you're counting as overhead expense. Yeah. Right. And so for us, we divide it up this way. Cost of goods is labor and materials that I'm spending on this specific job. Right. And for us, we are a project management GC company. So that means we don't have any labor on staff. We don't have our handyman or a painter staff member that's a W-2.
Right.
Every single labor that is happening on the job
1099 subcontractors
are all 1099. And we've set it up that way on purpose, and we'll debate you on it forever as this is the best setup for a company and why. But that's for another podcast.
Yeah.
So we take how much we've spent on labor and materials for that job, and that is our cost of goods.
Yeah.
Now, a third column is our overhead operations expenses.
Yeah.
Right.
Here's a clarity, a little bit of clarity on that one. If I'm working, it's cost of goods sold is any dollar that I spend on anything for a specific job.
Yep.
And a way to understand that is we have two different tool categories in our accounting. We have one that is factored into cost of goods sold because I needed to buy a tool to execute that job.
A saw blade for the demo.
Right.
We're using it up on that house.
I have a tool line in my finances that are in the overhead, which we're going to talk about in a second, that is a company cost that's not associated with a singular job. I needed it for that job, but I didn't need to spend, I didn't need to spend $500 to buy that saw for this job. I spent $500 to buy the saw for the company and was able to execute using it on that job, but it's not only for that job, so it's on a overhead cost, not a cost of goods. So there's kind of a line there. Any dollar that I spend only for a specific job, labor, materials, some of that we do is if we go rent a piece of machinery, that is associated with a job. I don't own that. I didn't buy that, but I spent money on that skid steer or pressure washer or whatever it was. I spent money on that for a specific job, so it goes under cost of goods sold.
Yeah. And now some guys are like, hey, I got a lot of extra profit in this job. I need this saw. I'm going to go and buy this saw on this job.
Sure.
That's great. If you're a one-man show, two-man show, and that's how you're justifying some purchases here and there, what you're really doing is spending the profits of the company on stuff that you want permanently, not necessarily for that job. Do it how you want, but accounting-wise, we want to start separating what's being spent for that specific job versus what's an overhead cost of the office, cost of insurance, cost of the power bill, utilities, employees. And so here's another one where we like to really decipher the difference between cost of goods and overhead costs. And for us, my project manager, I could take his pay and divide it between the 5 jobs he's running this week, right? I can say he works 50 hours this week. He's on 5 jobs. That's 10 hours per job. Let's divide it up and do that. That is a lot of extra work. And at the end of the day, it doesn't matter how we categorize it. If I'm categorizing more expenses in my cost of goods, my profit percentage is going to be lower, and that's okay. I can be at 20% profit if I'm categorizing my employees' time per job.
But the balancing out of that is my overhead cost percentage is going to be less.
Lower. Yeah. And so the way that we like to divide it up and that we teach guys the cleanest way to do it so you can scale your company is we have an overhead cost, which includes all of our all of our W-2 employees' payroll.
Office manager, project managers, management.
General manager. Everyone that is a W-2 is in the overhead expense that's shared by all the jobs. And then our cost of goods is labor and materials spent solely on that one job.
Yeah.
And we're harping on this pretty hard because all of your numbers are dependent on this. I hate when I see contractors arguing online about, oh, well, I charge 30%, I charge 20%, I charge 40%.
Yeah.
Of what? Of what are you calculating those numbers on? Because me charging 20% might be more money than you charging 40%. Because I'm charging 20% of all of my overhead,
Right.
versus you're charging 40% of just the labor that you're doing,
Right.
right? And so there's the percentage where you charge doesn't matter. It's how you're categorizing your expenses and how much profit I want above and beyond that.
Right.
And you
Right.
can't do that on a micro level per job. I can't determine the end of the year profit for the company on a per job estimating.
Yeah, and
right?
that statement goes back to something we've said before. Is like, if I want to be a big company, I have to act like one first.
Yep.
And yes, as a one-man show, a small company, you can manage it that way.
Yeah.
By individual job, I'm just going to determine how much profit. I'm gonna inch this one up, and I'm going to see if I can slide this one under for this client at 40%, 45%. And you land it, and I'm making all this money, and whatever. And that's fine. You can run that way, but you're not going to grow a large business by operating that way because it's not sustainable. You can't run that. You have to have it dialed into something that you know your numbers, you know your break-even point, you know I've got to hit these numbers at this profit to just pay the bills.
Yep. So those three numbers: your revenue, your cost of goods, your labor and material costs on average per job or across the board, and then your overhead expenses, right?
Yeah.
All of any sort of operational expenses that you have that can't be tied to a job is that third category.
Yeah.
Right. So we're going to take those three numbers and come up with all of our other numbers.
Yeah.
This is how we determine if we're charging enough. This is how we determine what we should be profit-wise charging. One thing also that we see with smaller companies is they don't understand that profit decreases on the exact same dollar as you grow. Right. And so today, we have 5 levels of company. We teach 4. The 5th level is when you start multiplying to other cities and start duplicating to other locations. But the first level, you're making 22% take-home profit, right? 22 cents of every dollar goes in your pocket when you're a one-man show on our level 1. Level 2, it's about 17%. Level 3, it's about 12%. By the time you get to level 4,
you're at 8.
Your goal is 8%, which is double industry average. But our goal is I want to be 8%. And beyond that, we try and stay around 8% at level 5 and beyond. But that being said, as you grow and once you get to a tiered company where you have a manager over your project managers who are over your crews, and you've got that 3-level tier of a company that you have to get to have a solid, large, decent-sized company.
Right.
Once you get to that level, you're making 8% at the end of the day, which means we're trying to hit 47% labor. I'm trying to hit 21, 22% materials, and then I've got 30 to 31% left over of profit.
Yeah.
And of that profit, I'm spending 22% of it on my overhead costs.
Yeah.
So I'm making 8%, and that's a really, really good number to make.
Yeah. If you're making, if you're averaging 32% profit, that means that you take out the 22%, you're making 10%, which your bottom line making 10% is really killing it. You're doing a great job. Odds are making 32% is not reasonable. It's especially in large jobs, you're in the 25, 28% maybe, right? And then you take 22% out of that, right? Your number of 8's dropping.
Yeah. Well, and a lot of this is our numbers are based on a residential renovation company, right? And so you get into building, let's say.
Yeah.
As a builder, I can do a lot more money, a lot more work, and invoice a lot more in a smaller amount of time with less overhead.
Right.
So I can work for 15, 18% profit. Now, again, you need to look. As a builder, I might be able to invoice $500,000 on this one build in 8 months, in 7 months, in 6 months.
Yeah.
That's great. Maybe you're hitting $80,000 a month on that build. As opposed to a renovator who might on $100,000 or a $500,000 renovation might take 12 months.
Right.
And so I need to cover my overhead for those extra months. So I need a higher profit percentage because there's more work, there's more hand-holding. And you have to understand that and what you're doing and how much you're giving to your client. And that's what I need to charge for. How much time is this going to take? That's why we have two different divisions. One works with investors and quick in and out, where you're not going to get the same level of service, but you're also not paying the homeowner pricing, right? And so we understand what product people want to buy, and we price that product to how much time and how much I can complete at one time.
Right.
And so we look at it that way, and we say, okay, so how do we get to looking at our overhead? How do we get our overhead covered, right? So if you're a one-man show, two-man show, if you've got a $10 million company, whatever size you are, your first stop in understanding your numbers is how much am I spending on overhead?
Yeah.
Which is my salary, my assistant salary, the office manager, a project manager,
the cost of your
insurance,
office, the light
the
bill,
toilet
the power.
paper, everything that you spend that's not on a job site. How much is it? Write it all out. If you should have it in some sort of QuickBooks or accounting system to see it, but you need to write out exactly how much you think it is.
Yeah.
So if I look at it, it's going to be for our company. Let's look at our company upstairs. We spend $10,000 per project manager on overhead for them. That's their salary. That's the insurance increase when they bring in their work. We know how much work each PM is going to do. We have to pay more
Gas,
insurance,
benefits, apparel.
Yep,
all
of that stuff. Cell phone, everything that we do, we have to pay for and account for. So when we look at our company, every project manager is about $10,000 a month, depending, give or take. But on an average, let's say our PM's making $65,000 to $70,000 in a year.
Yeah.
For us, that's costing us about $120,000 a year, almost double.
Yeah.
Almost double. And people are blown away when they start looking at these numbers because it's like, well, I made 150 last year. If I hire someone, that's going to cost me 70, and so I still got some money left over. No, it's going to cost you 120.
Well, I spend $500 those things that I've got an extra $2,500, $3,000, $4,000 a month that I pay above and beyond their salary just to keep them functioning.
Yep. So you need to understand, for us, when we break down our overhead expense even deeper, we've got two columns inside of our overhead expense, right? We've got our producers, right? We call our project managers the producers because if I can hire more producers, I'm making more money. That's our sales guys. Those are our project managers. And then we've got our operational costs, which is our office manager, our general manager, any sort of management above our project managers, as well as all of the office expenses, insurance, and everything else. So we divide our overhead into those two columns, where one is tied to every single project manager and one is tied to all the other expenses.
Right.
That way I can say a new project manager hire is going to cost me $10,000 a month.
Yeah.
And I know that it's going to take me 2 to 3 months to get them up. So I know I need to put aside $20,000 for month 1 and month 2 of that new project manager not invoicing. If you think you can get by on just, I'm going to pay this guy $4,000 a month until he gets going, and it's only going to cost me $8,000. It's not going to only cost you $8,000. Don't lie to yourself. Understand the numbers.
Well, another place of clarity is as an owner of a company, you have absolute right and should be running what you can through the business.
Yep.
But the money that you are spending to pay for your light bill, your truck, your eating out, whatever it is that you have a right as a business owner to be spending, those are not business expenses. Those come out of the bottom line profits. So you need to have a separate category that is owner expenses.
So we call it non-shared. And so there are a certain amount of personal expenses as the owner of the company that I can run through this company legitimately. Yeah. Legitimately, I can do it, and it's not ripping off for tax purposes, but it's something that I can justify as an expense that if I didn't have this company, I'd have to spend anyways, probably. Let's say I'm going to go to a conference in Miami, and I'm going, but I chose to, and I don't have to go, but I want to go do this to further my education. I can identify this in our accounting and say, hey, this is me spending our profits on my growth. And so I want to categorize that separately, because at the end of the year, we can go back and say, okay, well, we spent $4,000 on personal company expenses, and we can identify the difference of what is actual profit and what was spent profit on growth.
Clarity on that is that I want to remove those out. The owner's expenses don't need to come out of the 8%. You need to go to it actually comes out of the 8%. The owner's expenses don't need to reduce that 8% to 6.5%. Because and now your net profit is 6.5.
Yeah.
You don't factor that in. You factor it in afterwards so that you can see, you know what, my net profit is in line where it needs to be.
Really, I view it like if I fire this guy, if I fire myself and hire someone in, what am I going to have to? What expenses will I have to cover? Right. So if I hired a general manager to replace me, and I'm going to pay for a truck, I'm going to pay $400 a month for a basic little cheap truck that we put some money down on. That's a Colorado or something like that.
Right.
That's great. That's an affordable truck. Maybe for me though, personally, I want to upgrade and get a $90,000 truck.
Right.
Well, the difference of what I would be paying someone versus what I'm going to pay myself, I'm considering that. You know what? That's me just spending a little more on myself because I like it. I'm not dodging taxes. I'm not doing anything illegal. But I'm saying, hey, you know what? I wouldn't buy a normal guy. I wouldn't have a $1,200 a month payment for a normal GM.
Right.
But I'm going to classify that to understand this is part of profit.
Yeah.
Again, we're getting into the weeds.
Yeah, I was about to say that's a little bit of a rabbit trail, but it's interesting. I just kind of thought about the owner and making a comment about that. But getting back to the reason for understanding your overhead, that's where if you can find what your total cost is for overhead, that's where you start to determine what's my break-even point. What is your average profit that you're shooting for, and maybe not shooting for. What do you average hitting on profit? Right. If you're shooting for 25 and you really hit 20% by everything all said and done, okay, great. Then take your overhead number. Let's just call it $10,000 just for ease of numbers. Okay. If your overhead is $10,000, divide that number by 0.2, which is 20%. What that does is that gives you the revenue number that you have to hit while making 20% profit on it to be able to cover all of your overhead and all the bills are paid. Everybody's got a paycheck. All the lights are paid for. The facility's paid for. The gas is paid for. All of that stuff's taken care of. I haven't made any money, but everything's covered and paid for. That gives you your break-even point that now I can start looking into the future of the year of the company and start making plans. Okay, I got to break even. I got to hit 50 grand
per month.
Per month. I got to hit 50 grand per month of revenue. And I've got one project manager who's kind of an assistant right now, but he's getting up and running, and me. Well, I'm running, a couple of jobs, and he's running a couple of jobs. We can easily hit 50. 100 is easy for us to hit. Great. Okay, so now as you start reviewing these numbers on a monthly basis or quarterly basis, whichever one you want to do, you know that if you start seeing months that dip down, that you only invoiced 40 grand, you lost money that month. Unless you look to the previous month and you did 120,000 at 20%. Like, okay, you know what? I invoiced a bunch in January, and I paid it out, and I paid out some of my labor and stuff in February. Some of that happens, but it gives you that break-even point, so you know what you're looking at. I've got to be above this number, and it gives you some security to know, you know what? I'm not hitting the number that I want to be at, but I know that I'm doing well, and I know when I'm drop below this line, it needs to raise a flag. Is there a problem? Do I need to address this? Right.
Well, and it also helps you say, okay, I'm at 20%. I need to be at least at 25% to cover my overhead now, right? So you look at it with your simple numbers. Instead of 50,
you calling me simple?
Your simple numbers for you to understand. You look at the number and say, okay, hey, I'm not doing 50 at 10. Obviously at 10,000 a month in overhead, you don't have an employee. It's just your truck and some insurance and that sort of thing. So you're looking saying, I'm not hitting 50 a month, so I'm only hitting 40 a month. Right. Okay, so let's look at that. If you at 40 a month, you need to increase your profit because it's not profit. Right. You're not even breaking even, right? Or you can say, if I go to 25% and I'm doing 50 a month, then I'm now making profit on the company above and beyond what I'm covering. Right. So you got to look at those numbers and understand, what should I be charging? What am I charging? Right. We usually drop between what you are charging and what you end up at the end of the year, 3 to 5%. Yeah. If you're really good, you're at 3%, right? I was aiming for 30, I ended at 27. Yeah. I was aiming for 35, ended at 32. If you're very inefficient, I was aiming for 30, I ended at 18.
Yeah.
I was aiming for 35, I ended at 15. Right? If understanding that efficiency is important, but knowing what you're actually hitting is the most important. Not what you're quote unquote marking up.
Oh, right. Yeah.
Not what. Well, on my estimates, I do it at 35% every time. Well, great. You're hitting 25% profit. So let's look at that number, not what you think you're
well,
marking up.
and I think by exactly what you said, I think that kind of it shows you that by knowing and understanding these numbers, it allows you to be able to make decisions. Yep. It allows you to determine if you can hire somebody or not. It allows you to when you're not hitting the numbers that you need to, you go in and you look at your cost of goods sold.
Yeah.
Your cost of goods sold should be 68% total. Yeah. Of your of what your revenue is. Whatever your invoice is, if you invoice somebody for $10,000, $6,800 of that should be labor and materials. Just roundabouts, just kind of a target. But by knowing those numbers, if I'm not hitting the profit numbers that I'm supposed to be hitting, go in and dive into that. And you know what? I'm not at 60. I've been spending 75% on labor and materials. Why is that?
I'm missing my estimates.
Missing my estimates? Do I have a project manager who's just throwing cash to keep a guy happy? Are we doing a bunch of free fixes at the end that I'm paying a guy for? Mm-hmm. Right? It's those type of things that help you dial in those numbers. But knowing those numbers and reviewing them on a regular basis, you as an owner of a company should be able to kind of spout out an estimated roundabout for all of these numbers off the top of your head pretty much any given moment. I think if we asked our GM of the GC company, he would be able to spout out those numbers pretty quickly and easily because he's constantly in them, because he knows the power of the decisions of the direction of the company that he's trying to make and the hires and new business and opportunities he's trying to do. He's got to know those numbers.
Yeah.
And so I think there's an incredible value of, one, knowing how to get to those numbers, and two, reviewing them on a regular basis. Yeah. And this moves into the next space. If we're looking to make changes, new business, look to make a new hire, what does that look like as we're moving forward? How do I determine if I can afford to make a new hire or take on some new business based on these numbers?
Yeah, you can take it and look at it and say, hey, okay, we know that we've got these jobs planned through the next 6 months. Mm-hmm. I've got this, and this. I can look at this revenue. I think I can make it month over month. Right now, our costs are X, which means our revenue that we have projected with the profit that we've got built into this job is well beyond what our costs are right now.
Yeah.
So I can burn 20 grand on this new hire. I'm looking at it. I'm going to spend 10 grand this month, 10 grand next month, and hopefully break even the next month on this guy. If he doesn't work by month 3, I'm now hiring a second person. So now I'm at 40 grand I'm spending. Mm-hmm. I got to understand that and know that, because they're not going to make money day one.
Right.
And so I'm looking at it saying, this person who I hire, I've got so much work that I'm saying no to or pushing 6 months out. I can increase our work by month 3 for our company. Here's our number. At $64,000 a month of invoicing is our break even for a new PM.
Yeah.
So if you're hitting below that, if you're listening as an employee, if you're hitting consistently below that number, you're not going to work here anymore.
We're paying you to work for us.
Yep.
Or whatever.
We're paying to own this company. We're not making money off.
That's right.
So it's thin margins, but we understand I got to be at $64,000 a month. And so we set ours that we want to hit $79,000 a month. 78.5 is our minimum, and that way the difference of that, not a whole lot, 15,000. And if we're making 30%, maybe we're making 4,000 to 5,000 on an average month off a PM.
Right.
If everything goes well, and if there's no expenses, and if the trucks don't break, and if this doesn't happen, everything's perfect. That's our goal. Mm-hmm. We're not here to make $50,000 a month per PM. You're not going to do that. Even though you're increasing your revenue by that, you're also increasing your costs. Yeah. So we're looking at all that. We're projecting out when I make a hire, how much revenue should I be at, and how much do I need to get to? Where am I going to get that new work from? How am I going to increase by $600,000-$800,000 of business this year just to make this one hire, to break even, right? I can increase by $800,000 worth of work and make no more money for doing all that extra labor as a business owner. Yeah. So there's a lot of aspects that you got to look into, but understanding those three things get you all the information, right? So the last thing to hit is there's two main numbers that we pull out of these. We have our gross profit and our net profit. So with our company, I want to be hitting 30% gross profit. Gross is cost of goods minus revenue minus cost of goods. I invoiced $100,000. I spent $68,000. My gross profit is $32,000 or 32%.
Right. That's
a great number. I want to be between 28 and 32% for my gross profit. And then my overhead costs
22%
or 21, 22%. If we can get tight, get it down to 20, and we try and keep it below 22%. But that's about where it's going to be. So if I can hit it at 22, as a company this month I made 10%.
Yeah.
If we did $500,000 of work, we made $50,000 as a company this month.
And everybody's paid. Oh, there's no money owed to anybody. I made $50,000.
Yep. Part of that overhead though, and one thing that you got to remember to include is debt payback.
Yep.
Most guys have debt, and that's not on your P&L. Debt repayment is on your balance sheet, not your P&L, so it's harder to see outside of the interest. But again, getting in the weeds, what the goal is to understand how much money is going to go out month over month over month over month. How do we reduce that, but also increase the revenue while we're doing it?
That's right.
And to make sure we have the right percentage that we're marking everything up to where we're hitting profitability consistently. Next week, we are going to talk about when you have all these numbers, I take all these numbers, how do I look at this on a weekly basis, right? Yeah. We have some requirements that our GM does, as well as our office manager prepares some reports for them, and our head of construction also has his role in it too to understand what he needs to do. So next week, we're going to walk through our Wednesday meetings.
Yeah. Do you find yourself, on a weekly basis or monthly basis, having the thought of like, am I going to have enough money to pay for everything? I don't know how much is owed. How much is coming into me? And there's that stress, there's worry, there's anxiety of, I've got money going out that I know is going out, but I'm not sure if I'm going to have.
Where's the money coming?
Where's the money coming from? Right. Yep. And you look in your bank account and you're like, well, I should have 100,000 in there, but I've only got 30,000 in. So that's what next week, the next podcast is going to be about. Yep. How do we organize that to decrease that level of stress and organize? Here's how much money, here's how I manage my money on a weekly basis.
If you want a software that integrates into your QuickBooks, that runs a lot of your numbers for you and handles pushing all of this information back and forth, please go to our website, ProServeAlliance.com. Our software is killer at this. If you want to sit down and talk and show us your numbers, want us to help you dive into your numbers, as well as figure out a game plan for the next 12 months as to who you're going to hire, when you're going to hire, how this happens to get you profitable, and how we grow you over the next 12 months, please reach out to us.
Shoot us an email.
We've got some availability in terms of the coaching side. We love to talk with you. We're taking on a couple more coaching clients fairly soon, so we'd love to talk if you're interested. We'll see you guys on the next podcast. Thanks for joining us.
Thank you. Bye.